I'm Michael Fox, and this is the Prospector News Podcast. And I'm happy to have joining me again, regular contributor Jeffrey Christian, the founding partner of the CPM Group. Welcome aboard, Jeff.
Yeah, Michael, Happy New Year. Best wishes for 2023 and beyond. And it's good to be back with you.
Yes, good to have you, and happy 2023 to you. Talking about things that maybe were a little less happy. Let's do a review of the past year and what you saw going into the year and what actually transpired.
Well, you know, it's funny because somehow or other, we seem to have pretty much gotten it right. Our expectation a year ago had been that you would see relatively low economic growth in the United States and in the industrialized world, teetering on the brink and moving toward recession, but not necessarily being in a significant recession. We expected interest rates to rise significantly, but not rise to such levels as, to turn off the economy and throw us into a recession. We thought that interest rates would basically stay, even though they would rise, we thought they'd stay below, the levels that we've seen prior to the year 2000 and that recession. And I think that's what we saw. We expected inflation to start moderating and decline at a modest pace, which has happened. The economy was somewhat stronger in the second half, and the jobs market has been stronger in the second half. The housing market continues to suffer from the influx of institutional investment capital, squeezing out actual home buyers and individuals. Obviously, we were a little bit surprised at the Russian invasion in Ukraine, but I think we understand the cold calculus that the NATO and the United States applied to allowing it to happen. And we're pleasantly surprised at the way that the Ukraine government has been handling the war effort. So with precious metals, we had thought the prices would be strong in the first quarter of last year, then decline, start to rise in the fourth quarter. That's pretty much what happened. Yeah, it's kind of interesting because we do this thing called a quilt chart, where we look at 11 different asset classes. And, one is a cash equivalent, but it's high yield bonds, US fixed income, developed countries excluding the US equity, large cap equity, small cap equity, real estate. And if you look at the returns, the performance from the end of 2021 to the end of 2022, cash was king, rose about 4.4%, but silver was number 2 of the 11 in terms of performing at 3%. Gold was number 3 at a 0.13% loss. Number 4 was high yield bonds. They were off 11% last year. And everything else was off between 11% and 22%. So you had an environment last year, a financial market environment, where bonds and stocks did very poorly, and gold and silver did their job. They held up very well, and they smoothed out the volatility of any portfolio that had gold and silver in them, along with stocks and bonds. So that's sort of, a high level recap of 2022.
Wonderful. What do you say to the gold and silver bugs that say that gold and silver should be a lot higher than what it is?
I guess I try not to say anything to them, but if I had to say something to them, I'd say, well, you've been wrong for what? All of your investing life, 10 years in some cases, 40 years in other cases. There are people who have been saying that and holding to the same mess up of economic gobbledygook. The dollar's going to collapse, the treasury market's going to collapse. There are people who have been saying that since the 60s, the 70s, and the 80s. It hasn't happened yet. They probably should go to junior college or community college and take some economics courses, some money and banking courses, so they can understand why they've been wrong all their lives.
Yeah, well, you know what they say, a broken watch is right at least twice a day, as long as it's not moving.
Yeah, but this isn't a watch. I mean,
No,
yeah,
that's true. It's not.
the best one was a company that came to us and said, can you advise our clients? Because quite frankly, our clients, we're getting these letters like, dear Peter, my children have asked me to stop paying attention to you because I'm squandering their inheritance. You've been wrong for 40 years and I've lost so much money and I've missed so many bull markets and stocks and bonds by listening to your perpetual admonitions that the stock market's going to collapse and the bond market's going to collapse. And my children just said, Dad, please stop. You're hurting us.
Yeah, I think more of those letters should be written.
Yeah.
So we're going to turn the page here, and it's 2023. But a lot of the challenges of 2022 seem to be carrying forward, shall we say, into 2023. So what do you think that's going to end up meaning for the markets, and where do we go from here?
Yeah, well, let's start with the interest rates. Our expectation is interest rates will rise a little bit more, maybe 225 basis point increases in the first quarter, then plateau for most of the rest of the year. And depending on what's happening in the economy, they might start declining in November and December of this year, 25 basis point declines. And that reflects our economic expectation, which is that we will continue to see weak economic activity. We are slouching toward a recession. Our view is most likely you'll see a recession maybe in the fourth quarter of this year, but more likely in 2024. We think that you're going to see pretty much a continuation of the mixed economy that we've seen over the last 4 quarters. So that you'll see periods of negative contraction economically overall and periods of relatively stronger economic activity. And then you have to disaggregate that and you have to look at each component of the economy to see, what the real strength is in the real economy. Inflation, we expect to continue to moderate. We think the currency market will see reduced volatility. There will be volatility. We don't see the dollar falling sharply, but we also don't necessarily see it rising sharply from current levels. We've been writing and talking a lot about how, gold bugs and silver bugs primarily, but also some mainstream financial advisors, they have focused on monetary policy as being the cause of economic strength and inflation and economic issues that have arisen. And we keep pointing out that it's really fiscal policy and real fundamental supply and demand imbalances in the actual economy that have been the major drivers for these issues over the last several years. Monetary policy is a third factor that's affecting it, but monetary policy pretty much responds to the fiscal policy and the fiscal imbalances, not only in the United States, but around the world, and to real economic activities. And then you have to pay attention to political factors. It's funny because people say I should not pay attention to political factors, even though one of my degrees is in political science and international economics. But the reality is that the politics are inexorably tied to the economic and financial environment. And you've seen a reduction in international cooperation. That's going to continue. That will reduce the ability of governments to work together to ameliorate the global economic issues that we're facing. In the US, we obviously have a dysfunctional government, the UK the same way. Europe is sort of looking to redefine itself, while large parts of the European elite don't really care to have that redefinition. So I think there are issues in Europe that you have to pay attention to. Russia obviously has issues. China, the issues that have been simmering for some time have become much more publicly visible outside of China. And I think all of those political factors, as well as issues in Brazil and South Africa and the Islamic world and other parts of Southeast Asia and the developing countries. I think there are an enormous number of political issues which will limit government's ability to effectively deal with the economic environments they're facing.
Yeah, it's definitely going to be a challenge for governments to bring a hugely divided populace on side with any program, because one side wants to do something and the other side is prepared to fight them to the death to say no. And you're right, it's happening all over the world. Now, you're projecting a recession in the latter part of 2024. I've got a background in economics, as you're aware, and by the definition I was taught, we actually had a very mild recession in 2023, although nobody will acknowledge that we actually had a recession in 2023. What definition are you using for defining the recession that we're going to see in 2024?
It's not so much the definition I use as the adjective I use. Look, the mathematic definition of a recession is 2 quarters of negative contraction in overall economic activity in a national market. And, if you look at the United States, we had negative growth of negative contraction of 1.6% in the first quarter of 2022 and 0.6% in the second quarter. That's a recession. And, mathematically speaking, that was a recession. And we wouldn't be surprised to see 2 consecutive quarters of negative growth in the United States and certain parts of Europe and the UK in 2023 either. But what we talk about is not whether or not it's going to be a recession or when a recession is going to occur, because if you look at what was happening in the first half of 2022 and what we think is going to happen in 2023, you're going to have, as I said earlier, a very mixed economy. So you'll have pockets of strength. Last year, employment was very strong. Manufactured output was strong. Consumer spending and consumer borrowing were very strong. You had a very large fiscal stimulus from government spending. You had a lot of positives that were offsetting problems in the housing industry, supply chain interruptions, and weak auto sales and other things. So you had weak housing, weak auto, 2 very large portions of the economy, but they were offset by other things. And we think that you're going to see that again in 2023. What we're talking about, and it's not late 2024, it's sometime possibly as early as 2023 or the fourth quarter of 2023, but into 2024, 2025, we think there's an increased probability of a significant recession. So not 2 quarters of very low contraction, small contractions, but maybe 2 or 3 quarters of much larger contractions. A recession more along the lines of what we saw from the fourth quarter of 2007 into the first quarter of 2009, where you had like 6 quarters of shrinking economic activity. We're looking for a more significant recession, but we don't think it's going to emerge necessarily in 2023. But we do think that there's a higher probability that you will see that 2024, 2025.
I see. I'm going to ask about your outlook on energy costs. And the reason for it is that I believe that energy costs are the true elephant in the room. They're the ones that ripple through all of the sectors of the economy, and they're bringing on a lot of the inflationary pressures that the Fed is currently trying to fight. And my concern is, as the Chinese government reopens their economy from their COVID lockdowns, that it's going to put increasing demands onto the oil and gas and the energy sectors. That's going to put more inflationary pressure on those prices. And is that actually going to allow the Fed to start to taper off its rate increases going forward? And how basically how can that one little sector affect everything?
But yeah, energy is obviously the fuel that drives the economy. And it is critical across things. I think it's very important to note that if you look at oil prices, they really started rising in 2021, long before the Russian invasion of Ukraine and the various sanctions and limitations in energy flows since the Russian invasion of Ukraine. And that reflected the very strong economic activity in 2021 coming out of the 2020 lockdown. So you had very strong increase in demand in 2021, which was applying upward pressure. But you also had another thing. In the United States, you had independent oil and gas producers basically capping their wells or cutting back production. And they were doing that really for political economic reasons. And that constrained supply just as demand was rising. You also had OPEC and OPEC +1 doing similar things too. So, energy, especially oil and gas, have become political weapons. They become political weapons by people who want tax cuts and don't want the government cracking down on tax avoidance in the United States and in other countries. And it's also they've also become much more politicized on a global basis. And that's very worrisome. I do think that you will continue to see high energy prices. One of the long-term factors that we study a lot is the fact that energy transition rhetoric aside, the reality is that for the next several decades, well past 2050, oil will still be the major source of energy for humankind, and natural gas will be the second source, and coal will be the third source until 2040, and still be significant. So you're going to have a global economy and political systems and nations and governments and people all dependent on hydrocarbons. And the hydrocarbon market and industries have become heavily politicized, and that suggests higher prices. Now, whether that would be sufficient to cause the Fed to veer from its efforts to get inflation back under control, I don't think so. I think that the Fed, first off, the Fed probably has a better economic team making projections than most anybody else. I think the Fed will continue to disaggregate economic activity. They will see if you and I are right, that energy costs remain problematic to continued economic growth and to inflation. I think that they will be able to say, okay, that is an issue and it is a limiting factor, but we have to look at other sectors of the economy and other sectors of inflation to really manage monetary policy in a way that doesn't throw us into a recession or contribute to a recession being greater than it would be otherwise. I do think that energy costs are going to be a problem, not only in 2023, but going forward for many decades. But I don't necessarily see it as a major constraint on monetary policy.
So we've gone through the energy markets, we've gone through monetary policy, we've talked a little about the dollar index. Let's go through some of the commodities that the CPM group follow, and let's see where you think they're going to go for 2023. Let's start with gold.
Okay, our expectation is that you'll see some strength in gold in the first quarter. I mean, we've seen it really start rising in November and December. We think that'll continue for a while. Then our expectation is that seasonality and weaker economic activity will probably kick in and the gold prices may subside for a while. We wouldn't be surprised to see the price at 1880 or 1900, at least on an intraday basis, but I think it's going to be hard pressed to rise much more sharply than that, given our expectations of the economic and political environment. We don't necessarily see it falling as low as it did in the second, third, and quarters of last year and into October. But we do see the gold price. sideways. Some strength in the early part of the year, weakness in the second and third quarters, possible strength in the fourth quarter, especially if the Fed starts cutting interest rates in the face of gathering recessionary pressures. And then beyond 2023, we still expect gold prices to rise sharply.
Silver managed to outperform gold last year, as you indicated. Do you look for that to continue in 23, or where do you see the silver market going?
We think that the silver market, will trade between, I don't know, let's say 20 or 22 on the low end and 28 on the high end for most of this year. Like gold, we think, we're seeing some strength over the last 2 months. And yes, silver has outperformed gold, and it actually started rising before gold in the fourth quarter. We think that you'll see some seasonal strength in the first quarter, and then it also will quiet down in the middle part of the year and start to rise toward the end of the year. And then like gold, we do see higher silver prices beyond 2023, although, we don't necessarily see silver prices rising to record levels.
As we also discussed, auto sales in 2022 kind of sucked, and we know platinum and palladium are pretty consistent with the demand is tied to the catalytic converters out of the automotive market. What do you see for 2023 for those markets?
Well, we expect autos production and sales to continue to be weak in 2023. In addition to that, we expect another 1% increase in market share loss of petroleum-powered vehicles to electric vehicles. I think electric vehicles were probably about 10% of the vehicle, the light-duty passenger cars that we saw built and sold in 2022. And our expectation is that they might be about 11% in 2023. So you're taking out, you've got a weak auto market, which reduces the demand for platinum, palladium, and rhodium. Then you're losing market share, 10% last year, 11% this year, to electric vehicles that don't use them. And that is a limiting factor for both platinum and palladium prices. Now, within the complex, you are seeing this shift toward using more platinum and less palladium in auto catalysts. So that suggests to us that platinum prices ought to rise and outperform palladium, while palladium prices are seem more likely to fall, as they have in the first few trading days of 2023. So we're looking for platinum to be a more interesting investment than palladium in 2023 and beyond.
With the recession on the horizon, we've got the rest of the industrial metals. Is that going to be a headwind for them all? Or do you see one or two of those metals outperforming the rest of the group?
Our expectation is, weak economic activity or weaker economic activity will be a headwind for all of the base metals. We think lead has stronger fundamentals and could see higher prices, even in the face of weaker economic activity. But like we're expecting aluminum prices to decline modestly. We think that copper may be flat. The supply-demand balance in copper is actually turning more positive, in that the deficit is contracting on a cyclical basis. But there was a lot of bullishness in the copper market last year, especially in the first half of the year, about the energy transition and the need for copper to produce and disperse electricity. And I think that a lot of that was that optimism about copper demand due to the energy transition was premature and a little bit overhyped. And what we've seen in the second half of last year and what we think you'll see this year is investors continuing to sort of back away from copper based on these long-term bullish views and pay more attention to current supply-demand balances. So we're not looking for copper to fall sharply, but we're not looking for it to rise. As I said, we think lead might be a little bit higher. It's got stronger fundamentals. We think zinc might head a little bit lower. We think nickel is going to be pretty much flat.
I got one last question about 2023 and the economy. I'm going to ask the question, although I'm going to preface it to I always find this question bizarre because the nature of a black swan event is that we don't see it coming. But the question that, a lot of people ask in these projections, if there was to be a black swan in 2023 that would throw a lot of this out, what could it possibly be?
Yeah, as someone at the Fed said about me when black swan events became a meme in 2008, 2009, I spent my life looking for black swan events and preparing for them. And you can, hedge your economic activity to prepare for them. I'm not sure that I'm looking for a black swan event. What I'm looking for is a crisis in an obscure portion of the international debt market. And that's not really a black swan event. That's something that if you have studied global debt markets, you should be expecting. If you look at the financial crisis, 2007 to 2011, it started in the collateralized mortgage obligation market. If you look at the recession in 2001, it started with the tech stock bust. In 1991, it was a real estate bust and the savings and loan crisis. So people keep looking at the treasury, or gold bugs that look at the treasury market, and they think, what's going to go wrong in the treasury market? The treasury market's going to be the last place where a problem appears. What's going to happen is some obscure corner of the global debt market is going to have a problem, and that knocks over a bunch of dominoes. So that's what we've been looking at. Obviously, we pay attention to black swans. We also pay attention to white swans. There are some things that are quite possible to emerge in 2023 and 2024. I won't bore you with the details or the hypotheses. There are any number of factors that could occur that could be very positive for the global economy and surprise a lot of people who only see dark clouds on the horizon.
The white swan sounds much more preferable to the black swan, that's for sure.
There was a song in the late 60s John Hartford wrote called "I Never Thought the World Would Last This Long."
I have a corollary to that. I always say to people, if I knew I was going to live this long, I'd taken better care of myself. So coming up next week, actually, on January the 10th, our friends at the New York division of the SME are putting an online on-demand video conference together, and you're a part of that. Can you give us a little taste of what you're going to be talking about in your presentation?
Sure. I've been a friend of the New York chapter of the SME since the late 1970s. And for several decades, I would give an annual outlook on gold and silver to a dinner in the early part of each year. And we're happy and proud to be continuing to work with them, as well as the national SME. They've asked me to talk about the economic and political risks facing precious metals, base metals, and specialty metals, and uncertainties related to the energy transition. So a lot of the stuff that you and I have covered, I'll be covering in maybe slightly greater detail with some charts to illuminate and illustrate the points I just made here. And yeah, SME is a great place to find unbiased information, research, and analysis.
I agree. I've been involved with their in-person and online events for going on 5 or 6 years now. They put on excellent events, and I always come away learning more and more about the economics than I even studied in university, which I find a great appreciation for. For those of you out there that want to participate in the event, I am going to put the registration link at the bottom of the description of this podcast, and I would highly recommend that you register. Once registered, you'll have access to Jeff's presentation as well as all the other presentations that are going to be available. You'll be able to download them and of course watch them at your leisure, as opposed to tying up yourself for an entire day. With that, Jeff, thank you very much for joining me, and I look forward to seeing your SME presentation on the 10th of January when it becomes available.
Michael, it's always a pleasure to talk with.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.